The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events. Now, here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. Goldman Sachs, Dave, Goldman Sachs, they seem to tell us exactly what we should be doing while they do the opposite. You know, the last time they talked gold down and, of course, used Bernanke's name in the past as well. They are trying to tell us that gold is a ridiculous investment. It's a sure bet to sell for the next year. But, you know, the last time they did that, Dave, they bought 3.7 million shares of GLD, which is the large gold ETF.
Yeah, it is interesting to see sort of talk on the one hand and action on the other. Yeah. And I think men in the end are judged by their actions. And this is where I think the rubber meets the road. For investors who are concerned, you need to realize that the role of patsy is generally played by the general public. And the role of patsy, as we described a few weeks ago, you know, whether you've been Rothschild or Goldman, as it were, you know, turning that to a verb, this is something that can happen to you. And it has happened in the past where you're treated like the market patsy and you provide product at a discount for someone who wants to build a constructive interest. Building a large position in gold is not easy. Building a large position in silver is not easy because you're talking about very small markets. If you want to own a large position in gold or silver, the only way you can do that is by scaring it out of the woodworks. And if you can do that, granted, there's not everyone in the world who has the clout or the voice to do that, but Goldman certainly does.
Well, and I think, Dave, back on last year when they were announcing first quarter earnings for the various firms, you know, Merrill Lynch, Goldman Sachs, JP Morgan, you know, the rest, Goldman Sachs actually had not lost money on a single day for an entire quarter. Now, that's mathematically impossible if they're playing the game fair. But at the same time, when the client ratings came out, you know, if you're a Goldman client, one of the little guys, it was one of the worst rated firms. Now, let's face it, if anybody here is listening and Goldman Sachs is your broker, you need to understand you're the patsy.
But you're a privileged patsy because you had enough money to, and this is where money and sense are not necessarily compatible.
Right.
There's plenty of people who feel that it's a privilege to be taken, particularly if they're dealing with the likes of Goldman.
And Goldman says it's a privilege to take them.
That's right.
These guys are actually talking about that being a fair game. Now, but Dave, it's not just in the financial markets that we see this. I mean, look at the political grandstanding that's going on right now. And these guys are swinging some pretty big clubs that could turn into a problem. I mean, let's face it. The Japanese, the Chinese, they're going to get paid on their treasuries. We're not defaulting on our debt, but that's the fear that's right now being rendered in this political grandstanding.
Yeah, and that continues with the claims that this would be the first time that the U.S. has ever defaulted on its debt.
That's not true, is it?
No, the Financial Times was quick to point out that we defaulted in 1790. Now, it's a British paper. It went by their headquarters just a few weeks ago and is on the south side of London. They were pointing it out not because the British were defaulted on. It was Dutch bankers and the French government who had the debt, and we defaulted on it in 1790. Then 1933, we defaulted again. And more recently, we had a technical default in 1979. So we've never defaulted other than the three times just mentioned.
Right.
So the question of whether we will or in fact we need to, I guess that's worth pondering because the concerns are felt by the mass media here, by individuals here, and certainly abroad by our foreign creditors. The Chinese and Japanese, they've been very vocal in the last 2 to 3 days reminding the U.S. government to protect their investments. I mean, that's their actual language, protect our investments. Because, I mean, listen, you're talking about two countries that have north of $1 trillion at stake in that particular area.
Well, and I think we need to re-examine. We did last week the interest component on these Treasury debts that we're talking about.
Yeah, I want to correct a number because we estimated what was going to be finally published for 2013. The interest component on our national debt totaled $415 billion.
You had guessed 420 or 430.
Treasury Direct, I forget if it's .org or .com, but Treasury Direct has those numbers published. If you look at the interest listed there, it breaks it out by month. We thought it'd be 420 to 430. That was likely given the run rate, but September only totaled $19 billion in interest payments.
Only $19 billion, yeah.
Well, off of an average of 35 per month, right. It was actually on the low side. But 415 is the number. That's revenues on revenues compared to revenues of $2.7 trillion. So that puts the interest expense at just over 15% of all revenues.
Well, that sounds to me like something that we're going to continue to make, whether these guys raise the debt ceiling or not.
Yeah, well, and the other issue is if interest rates continue to move higher, that's where they've underestimated this year, and they're likely to underestimate in years to come. I mean, that's what we were pointing out last week. They blew past the official government estimates by roughly 60%. And, this is why Jack Lew, this is why Barack, they're running out of money.
Right.
You 150 billion here. That's what they underestimated the interest component by. 150 billion there. I mean, billion here, billion there. 150 there. It starts to add up to real money.
Well, they're running out of money, but let's face it. Again, going back to what we were talking about before, the Chinese and the Japanese, who hold a lot of our treasuries, should not worry about us missing a debt payment, should they?
Well, this is the part that's politicized, and I think dangerously unnecessary. We have enough income to make payments on the debt coming due and the interest payments on the national debt. The question is, do we have enough income for all the promised governmental promises?
So you're talking about Social Security, you're talking about food stamps, Medicare, Medicaid.
These are non-contractual and have nothing to do with our credit rating and debt maintenance. Politicians have for decades, what have they done? They've overpromised constituency groups. Why? Well, they've been in the process of buying votes. You say, here's the bacon I'm going to bring back to you. You've elected me to bring back that pork barrel spending to you, and I want your support in this election.
And so now, since we've got almost, what is it, 50 million people on food stamps, we're saying, well, we're going to give those first, and then the Treasury debt second. That's not really true.
No, so here's where the distinction is. They want to equate voter-promised largesse with our ability to pay our creditors. Both are an obligation in one sense of the word, but only one of those bears any relevance to our credit rating and the threat of an actual default. So, I mean, recall that, agreeing on a budget has always been easy. No, it's always been contentious.
Right.
I mean, it's literally, you watch both sides of the aisle. It's like hyenas fighting for meat scraps. I mean, the core issue for not just now, but in past decades, has been the inability to work with what you've got.
They're spending more than they're making. I can't do that for a long time, Dave.
Promise more in programs and payouts than you actually have in revenue and actual resources, and thus we have the need for additional borrowing.
Right.
Debt ceiling remains the issue. Debt ceiling remains the issue.
Yeah, Dave, it's not an issue of if they're going to raise the ceiling. It's just when and how much.
Right. So until that day, when we promise only what we have resources for, we're going to have sort of this contentious wrangling back in D.C.
Right.
Our credit rating isn't tarnished by larger volumes of debt. Political charades are enough for rating agencies to get their feathers ruffled. We saw that in 96. We saw that a couple summers ago, 2011. Those come to mind. Our creditors they're certain that with a 76,000-page tax code, we can extract more blood out of the turnip. We can get all the money we need to pay them off. I mean, that's why, no one's fleeing treasuries. They look at the average tax rates that we have here compared to the rest of the developed world, and they realize that the Treasury can increase rates considerably and fix this. Now, granted, that's a political hurdle to get over, but we do have the power if we will in fact use it. Not suggesting it. I'm just saying that our foreign creditors do look at this fairly objectively.
Mm-hmm. Well, Dave, put yourself in a position. Okay, let's say that you're a banker and you're looking at a business and you're thinking, all right, they want to borrow more money. Well, first of all, as a banker, I want them to borrow more money. All I'm looking at, or you're looking at, is their ability to pay back that debt. I mean, and we do have that ability. We're spending more than we make, but we still have the ability to extract, if necessary, what's needed.
And it does come back to that issue of prioritizing. We want to make good on all of our quote-unquote obligations, but some of our obligations are non-contractual. Some of our obligations we can default on, to abuse that word, and it's not actually a credit default. Right. It just means that Social Security recipients might not get what they are expecting. Medicare recipients might not get what they're hoping for. It means that all of the spending programs that are in place may have to be altered. And again, that's where politicians don't want to face the music.
In reality, it's not our inability to pay back the interest on that debt. We've got interest rates rising right now for other reasons, and I'd like to talk about that.
Yeah, well, it's the value value of assets held by foreigners that is being damaged, has been damaged considerably this year with the rise in rates. But, that's been happening for at least the last 4 months now. That's without being pressed up against any deadlines. So, we have to look at perspective and say, wait a minute, the media is really focusing on this date, but we've had a trend here that's pretty important. And this move in rates is a primary topic today. And it actually, if you want to know kind of where this takes my brain, it takes us from a U.S. storyline to one that includes South Korea, China, Japan, and very curiously, Hungary, Turkey, and about 10 different Eastern European countries. And we'll try to get into that a little bit more in the weeks to come.
Well, we had interviewed Robert Higgs, a couple of years ago. He wrote Crisis in Leviathan, and he talked about, watch out for this gigantic thing he called Leviathan, which is the government getting so large, it'll do anything to survive. And what we're seeing right now is a lot of things that are factors that would raise interest rates in another part of the world are being used for political reason because the Leviathan is trying to scare people.
Right. So the rise in rates is one thing we'll talk about. The other is it's equally important, this fact that government would love to live and fight and grow another day. And by the way, they will. They will. This is really interesting. Is Ken Rogoff, of course, he's Harvard economics professor now, he warned earlier this year, the government is going to tax yourselves out of existence. He went on to advise buying the old masters and hiding them.
The paintings. Right?
Yeah, exactly. At this juncture, you as an investor need to be aware that the Leviathan is moving into survival mode. What isn't hidden will be taxed or simply taken. Further capital gains taxes, dividend and income taxes, fee assessments, one-time wealth taxes. If it's been done in the history of mankind, it cannot be ruled out at this point.
Including
confiscation.
Bail-in. I mean, we even saw bail-in over in Europe.
Well, right. And that's, when you look at the confiscation of assets, that can be accomplished in many ways. We've already got a couple of them in play today. Right. We've talked about interest rate repression, financial repression, where you keep interest rates at a very low level for a long period of time. We're now in our 4th year of the zero interest rate policy, better known as ZIRP. And, this is interesting because they are redirecting income away from households to the national or the federal ledger. Inflation, that's another one. Inflation via expanded money supplies. We've got M2 and MZM. They're rising at about a 7% annualized rate. You've got the potential for new taxes. This is what I'm saying. I mean, you could make a laundry list of ways in which confiscation of assets occurs, and we've got half of them already in play. The other half are coming. Why? It goes back to that issue of Leviathan. They will survive, and you are the means by which they will survive. You as an individual investor. So, again, when I say it's equally important, I think this issue that Ken raises, you need to consider it.
Well,
and again, he's not a scaremonger. He's an econ professor, actually chess master before he was an econ professor and kind of happened into economics. But frankly, the interviews that I've seen with him, he's a pretty boring guy, not sort of bombastic or, exaggerating certain points. This is the issue. Government is going to tax yourselves out of existence. That's what he said to a group of investors this summer. Why do you buy a Renoir? Why do you buy a Monet, a Manet? We talked about modern art. Note that he had the good sense to not recommend buying a Jasper Johns or, another modern artist. You buy the old masters and hide them. The key is not buying the old masters. The key is the second part of that equation. Hide them.
David, I think of the retired people who are listening right now for the last 4 years plus who've had to scrape just to make it because they're not earning any interest. So what they did instead was they moved to other assets. And even that, we're seeing taxation and confiscation. Okay, but most of these retired people listening cannot afford a Manet. They cannot afford a Monet. And frankly, they don't want a Van Gogh. They just want to have something that will retain assets for the next generation.
Well, and one of the key elements of the old masters that I think is a disadvantage is you can't bury them.
Right.
You can't bury them.
I know what you can bury.
Right, exactly.
And I know what holds value.
It underscores a very important issue. The nature of physical gold ownership, think about this, it's inherently anti-big government. It's one of the reasons why it's not particularly popular with government, but it's one of the, again, it's inherent to its nature. Number one, it creates independence from the system. Right. You've got big government. They're only too happy to see the number of dependents rise. And this is something that does give you an out in terms of the system. It gives the individual, number two, control over their personal financial data.
Well, that's privacy from Big Brother, Dave.
Well, I mean, look, we've got the rise of quote-unquote big data. It's given government access to everything we do. There is a thin line between access and control. Big Brother is not an Orwellian boogeyman.
No, it's here.
Yeah, I mean, you've got Big Brother as the NSA. You've got Big Brother as Homeland Security. You've got Big Brother as the Leviathan currently on temporary furlough.
800,000 people. Dave, if these people are non-essential, why do we continue to hold on?
Isn't that a great question? I mean, is any wonder why we're broke? Private sector analysis would say if they're non-essential, why are they working for you? They aren't.
Right.
That's what defines a pink slip. They're no longer essential.
Do you have any non-essential people working here at McAlvany Financial right now?
No.
Okay. All right. Other than myself.
Well, but, the other thing, again, the nature of gold. When big government moves to protect itself by any means necessary, your big savings become little savings, either by outright theft or indirect thievery. That goes back to inflation, which robs the saver via a negative compounding. And, you want the quiet, non-existent assets, and maybe even the portable asset. I think Rogoff, again, he may like Monet's or Renoir's, but as I mentioned earlier, you can't bury them.
Right. So, David, as long as you're saying we have a Federal Reserve, we have the ability to print money, we have a Treasury, we have the ability to tax, what you're saying is you have to have something that can protect that asset from those aspects.
Well, last but not least, we need gold because the Fed exists. I mean, This is really basic. We need gold because the Fed exists. And I suppose if the Fed went away, you could rethink an allocation to the physical metals.
Well, we're on the 100-year anniversary right now.
Exactly. The Federal Reserve, according to government inflation calculations, in that time frame, 100 years, has caused a 96% loss of purchasing power.
And that's using government calculations.
Well, and so this is their first mandate, price stability. How have they done? On a self-graded basis, they get an A+. On an objective basis, we, the consumers, would say 96% failure rate. Gosh, that doesn't even register as an F-.
What that means is a dollar is worth 4 cents today.
Well, the other thing that we're celebrating the 100th anniversary of is the income tax. And you can recall that our tax code then, at its inception, 1913, again, income tax, we had 400 pages which governed our tax system at inception. Now, we basically added 700 pages every year to bring us to our current 76,000 pages.
76,000 pages of tax code.
This is 4 times.
I've read it, along with Pelosi reading the health care bill.
Right, just like I've read Encyclopedia Britannica from cover to cover 4 times, because that's what you're talking about. 4 times the length of Encyclopedia Britannica. Has anyone alive read the tax code? I would bet you $100,000 that there's not a single person on the planet that has read every word of our tax code. I don't know that it's possible.
Okay, so we were talking about the Fed, then we talked about taxes. I want to go back to the Fed for a second, because quantitative easing should be picking up any of the slack right now in the treasuries that aren't being sold. I mean, we saw that the Fed was buying over 100% of current issue treasuries. So why are interest rates still rising? We don't have to entice the rest of the world if we're buying them from ourselves, do we?
Yeah, well, that's the issue. Our foreign creditors are seeing a rise in rates. They're seeing the Fed really, in essence, losing control of the bond market. But what's interesting is their concerns are almost self-generated. And let's look at that, because, rates have been rising as the Fed has kept QE in motion.
Right. Quantitative easing still going hard.
So we go back to a topic that we discussed last year, what I would call dollar recycling. And then this is Paul Craig Roberts. In an interview we did with him, he did, I think, an admirable job in sort of shrinking this down. When did we do that? 6 months ago, 12 months ago. But you start with, just for example, you start with an American consumer, and they're buying things at Walmart. And the product comes from China.
Right.
And the company that made it, manufactured in China, they get paid.
In dollars.
You have an inflow of dollars into China. And once it's converted to yuan, the domestic currency, it puts pressure on the value of that currency, the yuan, higher. Okay. Now, the Chinese government wants the currency at a low level. Why? So that the country continues to have a trade advantage, so that their products continue to move, and they continue to have a strong employment picture. Because listen, you have unemployment in a place that has billions of people. Guess what you have? Social unrest, chaos. change in leadership, and nobody wants that. So what do? They intervene. They print yuan. They buy dollar assets.
Like Treasury bills.
And the GSEs, government-sponsored entities, Fannie Mae, Freddie Mac. Those are the popular things earlier in the decade. And by buying the dollar assets, they offset the increase in yuan values coming from the inflows of dollars. So essentially what they're doing is neutralizing the currency appreciation and allowing the Chinese manufacturer to maintain a trade advantage. Great benefit here for the tradable goods sector, and there's a direct cost to households because this is inherently inflationary.
Well, and so let's look at, I have to think in simple terms, Dave. Okay, Paul Craig Roberts, when he was talking about how our government financed itself for so long, what we did was we ran about a $400 billion trade. We ran a deficit. They ran a surplus with us. They turned around and bought our Treasury bills, and that allowed us to go into debt and have $450 billion in government debt each year. Well, that fueled it. We had a trade deficit. They had a surplus. They bought our treasuries. The problem is, Dave, now it's 1.5, 1.6, 1.7 trillion that needs to be sold. So the Federal Reserve's having to print that money. But the other problem is, Dave, that was based on U.S. consumption. People going down to Walmart, buying lots of Chinese goods. That's not happening in mass right now.
Yep. So when the U.S. consumer cuts back on spending, and the Walmart numbers, if you're looking at these things, they do indicate this,
right.
The Chinese don't see the yuan appreciation due to dollar inflows to the same degree they were before.
Right.
And the Chinese government doesn't need to be as active in printing yuan and buying U.S. dollar assets to neutralize the U.S. dollar inflows. In essence, the emerging market demand for treasuries goes down. It wanes when the developed world consumer quits spending. So the yous and me's and anyone across this country who quits shopping or tightens their belt a little bit, doesn't buy everything that they used to at Walmart, it affects what the Chinese government has to do in terms of dollar recycling. There's less dollars to recycle. And guess what that means? As Paul Craig Roberts pointed out, we can't finance our debt needs, our refinancing needs.
Well, and this is a predictable outcome to a consumption-based society. I mean, if over 70% of our GDP, Dave, is derived from people going down to Walmart and buying things, and then you have actually mom and pop right now looking at the budget and saying, you know what, we can't go to Walmart this week. We're not going to buy those extra things. They're deleveraging. Debts are starting to get paid back. I mean, that's a good thing, except for with the system that we have built up, they say, no, that's a bad thing. You have to keep going into debt. You have to keep spending to make this thing work.
Yeah, so we can't just return to 2007. We can't just return to the 1990s and expect households to be very interested in leveraging up and adding debt to their total balance sheet. Why? Well, mom and pop aren't comfortable racking up lots of debt, and there's a reason for this. You know, they're more cautious in their spending. This isn't just an economic issue, concerns about the 2008, 2009 slowdown, and are we going to recover? Are we going to get back to where we were? But, you know, they're paying down debts for a very specific reason. The growth rates for household debt were just spectacular for about a 15, 20-year period, but there was sort of a pig in the python, if you want to call it that. You had the baby boomer generation, and this sort of young and up-and-coming generation was only too happy, and statistically it's pretty common for sort of 35 to 48-year-olds to be adding to the debt equation, and then at a certain point, about 54 years old and thereafter, you start diminishing the debt that you're willing to take on as you move towards retirement. You make a deliberate effort to pay off as much as you can so that you can retire and not be feeding the meter in terms of interest payments.
Well, if we were to rerun back to 2003, 2004, 2005, most of that consumption was being fueled by mortgages, okay? It was the explosion that we had in real estate because of the mortgage explosion.
Yeah, well, and that's, you know, U.S. household debt particularly influenced by home mortgages. It's at the lowest levels we've seen in 60 years. We're talking about the growth rate of debt. That's right now compared to where we were just a few years ago. And so if our appetite for consumption, you know, fueled by credit, whether that's credit cards or home equity loans or what have you, if it's not growing, then what we have is a mismatch. We have a mismatch between government financing needs and the natural audience of creditors, that is, foreign creditors that aren't buying as many treasuries in large part due to U.S. consumer deleveraging. You could think of this as sort of a demographic deleveraging in the sense that as people age, again, they're more inclined to pay off their debt. And they don't take on any more. That's that pig in the python. That's the baby boomer generation. That's why I say it's demographic in nature. They want to retire. Debt service sucks up too much income. So before moving to a fixed income, debt gets retired, and current income goes to that end rather than consumption.
Well, and what about student loans, Dave? I mean, that's the new norm.
The next few generations carry an ever-growing burden of student loans. And, we had previous generations that didn't have all this burden as they launched from the nest. And, as a young adult, they considered a first-time home purchase, and it looks more and more like we are stuck in a set of demographic ruts, because it's not just the baby boomers, it's also the up-and-coming generation. One generation is deleveraging, getting rid of debt. The other is as leveraged as they can be already, and they're unwilling to leverage up to go into more debt. This puts the onus on government to continue to spend in order to keep our GDP at a healthy place. And this is this Keynesian notion of propping up aggregate demand. You don't want to see total demand in the economy shrink, so if the consumer backs away, government temporarily steps in. Now, temporarily, let's redefine temporarily. Is this 1 year? Is this 2 months? Is this 10 years? This is an entirely new system, and it's not healthy.
Well, and the nightmare to the system is when rates rise because there's not that much of an appetite for treasuries and people really don't have enough money to consume or spend. So you have rising rates, but you don't have rising growth.
Right. If you don't have the folks who had the appetite for treasuries, if they do cut back, again, they're not filling the function they did before. They don't need to. Again, this goes back to that exchange rate management. They don't want their currency to appreciate, so they've got this money newly created, yuan, and they go out and buy U.S. dollar assets with it. So what's really awkward here for both the Treasury and the Fed is that they're not really in control of their own destiny. There is a need to fund the government. They have a shrinking audience of creditors. And, within this financial picture, listen, we've got an improvement on the one hand. We've got the wealthy via asset appreciation, and then you've got the larger economy, which remains stagnant at best. And this is where that larger consumer base is coming from. And that's the component that drives foreign demand for treasuries.
One of the other things that's been fueling us, Dave, since we had the real estate collapse is the rise of emerging markets. I mean, they filled the gap for a while, but at this point, the emerging markets, these smaller countries that were fueling the treasury buying, those are also shrinking at this point.
Well, they've become a much more significant part of the total picture. Your emerging markets now represent close to 50% of global GDP. So whereas they were less of an issue in the 80s and 90s, they're a much bigger player today in aggregate. And, so things that are changing there, they do have a ripple effect. It's not as if sort of the small butterfly causes typhoons on the other side of the world. We're not talking about small butterflies.
Well, they needed our consumption to continue to grow. We stopped consuming. They stopped continuing to grow. It's a symbiotic, it's sort of a dangerous symbiotic relationship.
Well, so there's a second issue for the emerging markets to deal with. They have decent balance sheets, okay? They've got decent balance sheets because of the glory days of Western overconsumption. That's very clear. But income is in decline. So again, you can always look at a company and say, well, how's their balance sheet? Great. You also need to look at sales and the income statement and see what's happening in terms of money coming in and money going out, because it's not just a question of a snapshot in time balance sheet, because clearly emerging markets are in a healthier place than we are in terms of debt levels and everything else. Well, I say some emerging markets. There's actually a few that are dangerous, and that's what we're going to get into in the next couple of weeks. But income is diminished to a degree where they, in fact, need to rebalance. They need to restructure. You've got surplus countries which are reverting to the mean, and that can cause a tremendous amount of flight capital from foreign investors.
Well, and Dave, that takes it from the emerging market side to our side. That cuts into our gains.
Because to the degree that you have something happening, is sort of a restructuring taking place and capital flight from the emerging markets, there is a knock-on effect to our domestic financial markets. Look at Mexico in the 80s. Look at Asia in the 1990s. We had a need for, well, I don't know if we had a need for, but we did see the Fed step in and intervene significantly as you had these hiccups around the world, and there was sort of an echo of concern into our own markets.
Well, and we had the ability to lower rates. I mean, we've seen crisis in some of the emerging markets in the past. They could be met by just our lowering of rates. The problem is now, Dave, with ZIRP, we don't really have much more to go.
Yeah, well, you've got the flight of capital, which was crippling for local currencies, and it required a tremendous amount of currency intervention, massive selling Okay, massive selling of those assets. It shrinks the value of an emerging market currency, and it creates an inflationary concern for the man on the street. If you want to avoid social dislocation that comes from that sort of externally driven devaluation, where you have capital flight and foreign investment are just being pulled from these emerging market countries, then governments end up reversing the role played earlier in order to keep their currency at a stabilized lower level. Now they have to prop up the currency. And here's the crux. If they're going to prop up their currency, what resources do they use in order to stem the tide of currency devaluation in their domestic markets?
Well, they own a lot of foreign assets. I would think that that's what they dip into. They'd sell their foreign assets.
We are the foreign assets. Surplus countries in the emerging markets, they are a probable igniter for the explosion of the U.S. debt markets. That is that, you've got rates that rise for several more years, and then we see prices in the bond market dropping. Precipitated by what? Is it the wrangling in Washington? No, it actually is stuff that's been in play for about 5 years now. Arguably, the genesis is even before that. But you've got an unhealthy balance of payments, and that ultimately has ramifications as surplus countries rebalance. And as surplus countries rebalance, the implication is they don't need, and they may in fact use the resources on their balance sheet to defend their currencies. And that means an outright liquidation of treasuries, really tipping the scales. Right now, there's less of an appetite for treasuries. If you go one step further, from lack of appetite to puking treasuries into the market, guess what you have? You've got massive crisis here in the U.S.
Well, what we're really seeing, Dave, as complex as this is, because I'm telling you, having to go in and buy currencies and move this and that, there's a lot of complexity in the system. And for the person who doesn't follow this every day, they're like, well, I don't really know what that means. But what it really means is we had a model, a consumption-based model that worked for about 40 years. We were able to buy from China, let's say, and they were able to buy treasuries back from us. It was a scratch-your-back kind of thing. We scratched each other's back. But a system that's based on people needing to spend more than they make and continue to borrow more than they can pay back, that may look prosperous for a while. But this is what the death throes of that false paradigm bring, Dave. So what's the takeaway in this?
Well, we're in an interconnected and interdependent world. We must, even though if this seems boring, we must care about European bank exposures. We must care about Asian economic rebalancing. We must care about sort of the stocks and flows of treasuries, who owns what, how much of that stuff is on the move in the marketplace. Again, for the novice, the non-professional, or the merely curious, this may seem like a large burden. Why should I care? It's the implications. It's what happens to a system when, again, as you described, Kevin, the system, as we've known it, is coming undone. In the coming weeks, we're going to explore sort of the large levels of foreign currency indebtedness and the likely devaluations amongst European countries. This includes European bank vulnerability and a potential feedback loop into our financial markets. And we're talking about $1 to $2 trillion worth of exposure, which makes Lehman look like a walk in the park. And this could very well be what tips our stock market into chaos within months. So let me ask the question, do you care if the stock market trades lower by 30 to 40% in the next few months?
Well, you better.
Well, you better, and you must therefore care about foreign currency indebtedness. You must therefore care about European countries and European bank vulnerability, their exposure to Eastern European liabilities. These things which seem like boring minutia are, in the fullness of time, the kinds of things that cause Lehman collapses, that cause systemic crisis. And we have them more front and center and prominent today than, in fact, we had in 2007 and 8.
Well, this brings me then to why I own gold, Dave. I've been with your family as a company for 26 years, and I've seen the entire decade of the 1990s and the last half of the 1980s when I first started. People weren't buying gold because they got on the internet and tried to figure out whether the price was going up or down that day or that month. They didn't buy it because it went up. They bought it because it wasn't what we're talking about right now. It was away from that. Do you think, and I know you do because we've talked about this, do you think people are focusing too much on short-term price moves on gold right now and missing the point that they can actually get something of value and trade something that's not valuable for it?
Yeah, on Wall Street there's this common phrase, picking up pennies in front of a steamroller. And it can be, where you're trying to do something that you shouldn't in terms of an asset. What comes to mind when you ask that question, Kevin, I'll kind of rework that analogy. When people are trying to pick up a $100 move or a better price by this or that, or save a few bucks here or there in commission, you know what you're forgetting? You're forgetting that the nature of physical gold ownership is inherently anti-big government. And you need to get your facts straight, and you need to get your priorities straight, because if you don't have independence from the system, if you don't have financial privacy in some form within your financial balance sheet, if you don't have a way of protecting yourself from outright theft, just understand you are the fodder that feeds the Leviathan. You are the necessary ingredient for the growth of government and the survival of government in the years ahead. And good luck to you. This is, again, I'm not trying to be harsh or cruel or anything else, but yes, you should own gold. You should own gold for the right reasons, and you should insure against your own financial demise and try to refashion what can and should be and ultimately will be an enduring financial legacy. But that does mean that you have to look at the system with a jaundiced eye. And so when we look at sort of the second point here, we did talk about gold. We also talked about the fragility in the financial system. Be careful. Be careful. Fragility is the new market constant. And all that we assumed underscored support in the financial markets, you can't rely on it.
Right.
There are changing relationships in international trade, and there's changing demand dynamics for products and financial instruments with major ramifications for the U.S. stock and bond market. I don't have to even mention the U.S. dollar, but that's part and parcel to the equation. These are issues that you have to keep front and center as you're making real-time decisions right now.
You've been listening to the McAlvany Weekly Commentary. Now, I'm Kevin Orrick along with David McAlvany. You can find us at McAlvany.com, McAlvany.com, or give us a call at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.